Hi everyone, this is my next recording right after the one that I made around the budget, and my key expectation at that time was that probably you could see a rate cut after the budget, but probably if you heard me at that point of time, the budget itself looked at expanding the fiscal deficit a bit, and with that pressure point, it was not very clear as to whether he'd do an immediate cut, because he would have only so much room to go ahead with rate cuts, and of course there are some people who thought he would just front load it in the April meeting, but he did just as expected, that right after the budget, within that first week, he went ahead and did that first rate cut. But what's interesting is what also I said in the last video, is that I could see ending patterns across indices, and I think that view played out completely throughout the month. The high that it made on the rate cut day ended up being the high for the month, and for the wave E high for that structure. And I think after a very, very long time, we've seen the market actually close down for the entire month, right into expiration. Otherwise, typically when the bull cycle is still going on, or the strong hand is still pushing up, usually in the last week, the pre-expiration week, market often bottoms and tries to extend to the upside. But we didn't see that happen this week, and that's a sign of clear weakness. But apart from that, we got many other signs breaking of the entire rising channel from the August 2013 lows. For the first time, all indices broke their 20-week averages. The momentum indicators were already in sell for the last 2 weeks, I think, for India and the US markets. But breaking of these averages, which is for the first time since the entire structure developed, was a completely new development. And that to me is a form of confirmation, because if a particular pattern or trend is held out for the entire time period and it reverses, it means that that whatever is going on is complete. Of course, we'll have the monthly and quarterly closes by Tuesday in the coming week, and it's possible that you end up closing down not just for the month but for the quarter as well, and that would further end up confirming what I've been saying, because after almost 6 quarters, I think, or 7 quarters, we would be closing down, and that would be a sign that whatever happened prior to that is complete. So once you're complete, the question is what has happened. There would be 2 discussions. The first one would be whether you're just correcting the entire 1.5 year rally, and it's just it's part of that ongoing trend, which is not what I think, of course, because I have not called this rally a bull market. For a long time I've questioned that idea. I've tried to think about it, I've tried to portray the possibilities if it was a bull market, but my expectations have not been met either in terms of the technicals, the breadth that I've seen in so many bull runs since I started watching markets in 91, which means 92, 94, 2000, 2008, or even the 2010 recovery. So essentially I went ahead and called this a Modi bubble way back when it started in June. And later I said that, well, if I don't want to call it a bull market, I might just call it a bull run, because it's one of the weakest bull runs in which the index attempted to almost double. And in terms of participation, breadth, volumes, the comeback of investors to the market, this was probably the weakest. Even though I compare it with Y2K, Y2K had far wider participation, even though it was only in the tech stocks and in the speculatives. It was far wider than what we have seen right now. Now, many of you who've been hearing me recently would have mostly heard me on the bear side of the case, and so when we get a good month, I've tried to put out that and take the good comments that people have had after having followed that move and finally seeing it play out. But here's the thing. I mean, when I try to give a macro view on the market, I'm essentially taking a very, very long-term posture. Of course, the immediate trends can keep changing, and my daily and weekly updates, we do keep changing the trend from up to down, which is one part. But calling something a bull market or a bear market is essentially about whether the whole market is going up. One, second, whether the whole economy is playing out as expected. Which is why around almost 6 to 8 months back, I shared a report that we put out way back when I joined Sher Khan, which is almost 14-15 years ago, and Yeah, that's exactly 14 years now. And back then, within 6 months, we put out a note saying that the bear market at that point, the business cycle was down from 94, and I quoted that that bear market is over, and we would be starting something which would be a bull run that would last for 10 years at least. So that's the big call that I made at that point of time. The number of readers for Indiacharts at that time would not have been more than at the start, 50 to 100 people reading the weekly update that I used to put out for very, very long. So you understand that most of the people who know about my call then all the way till 2007, that's just 10% of the people, or maybe even much less than 10% of the people at that time, because I started promoting this website, and it's become more widely read only after 2007. Based on my promotions online and the social media updates that I started only in the last couple of years. So which is why I would say almost 90% of the people who read me would think that it's that 90% of the time I'm bearish. So it might be fair to say to actually put out a bull call, because I don't know, I haven't felt more optimistic than any time before that I do now, and here's the reason. In 2009, that's the first time I actually published the Counter-Type Winter articles, because I felt convinced that when you rebounded from the 2008 lows, and at that point I did write that the market might have bottomed and should rebound, but my expectation of the rebound was essentially that you'd retrace, and we'd retraced almost 61% by Feb of 2010. Okay, so that's exactly when I think I wrote that first note. It was February 2010. So almost a year into the previous rally, and I said, no, the economics factors that I'm looking at are not adding up. I'd been studying the Counter-Type cycle, and I think I couldn't put it in perspective till I saw much detailed work on the US markets on it, and then was able to just plot the same cycle based on those couple of parameters that the long wave group put out, which covers the cycle. Essentially, it's inflation, interest rates, debt, commodities, gold. These are the handful of items that go into it. The next Counter-Type update which I'll be writing, I will share a part of that which makes me feel that what happened in the bond market in 1929 in the US is similar to what we are seeing now. Just because so many world markets or debt ratios go beyond what we've ever seen before, the comparisons with 1929 appear absurd. But you need to remove that from the block and look at the cycle in historical perspective, and then I almost come to the conclusion that we have a lot in common with what happened in that cycle in the US study with what is happening in India today. It's quite surprising when you just look at how interest rates behaved or how commodities behaved, and there's a lot in common to be really taken up from the cycle behavior. And so, so what's the call? It's that we've been in a winter. I think in 2009, when I published that, most people said no. While there is a slowdown, it's not a debt-related issue. Come 2014, I think for the first time we started accepting that we have a debt-related issue, and come now, everybody is talking about the NPA problems in the banking sector and so on and so forth. So the cat is out of the bag. Nobody wanted to accept this is the truth. The next big thing that has happened, you've got a big rally into 2015, but for the first time you have a divergence in economic and fundamental data. Earnings grew negatively. Nobody expected that. I think nobody expected even GDP growth to be falling over the last 5 years. Every year I've seen projections to the upside being cut back, which means nobody got it. None of the economists got it right, that numbers were just going to fall back. And finally the government just reject the numbers to give you a better picture, which continues to remain a debate. It's fine, we'll all adjust to looking at the new numbers and contesting what it means for the economy, but based on available historical data, we've essentially seeing what we call a divergence between at a new high. You got an economic divergence between the data, and that's a sign that the fifth wave is ending. For a long time I thought maybe the fifth wave ended in 2010 at the most, but the entire structure from 2008 to 2013 now is triangular, and which means the fifth wave is just ending now. So what makes me makes me an optimist, which is what I was just talking about. The optimism comes from this. Now that it's apparently clear that we are entering the last and final part of the winter cycle that I've talked about for so far, and in 2009 I expected a 5-wave bear market, which we mark as a complex pattern. We mark that as W, X, Y, X, Z, where each X is a rally. So we got an X wave in 2010, then we got an X wave into 2013, and then after that you got another correction, and there was just one more X wave left, and it actually ended up being the 5th wave. So you got that one more run into 2014-15, and this makes it either Z or the start of the next bear market, which could be complex or could be a simple ABC. Time wise, it could last for between 12 to 18 months, so I think that's the outset, and that's what is so interesting, that now when you're onto the final leg, 12 to 18 months is the approximate time based on what happened between 2000 and 2001. It took around 18 months for that bear market to complete, but what we are doing now is we are completing a super cycle degree cycle, which means the entire 5 waves starting 1934 all the way into either 2010 or 2015 based on how you mark it, and then completing that cycle by actually completing the debt cycle, which would mean writing off of debt, reconstruction of loans, maybe many companies closing down, which we've already seen a couple. There could be more of that, and that cycle completes the business cycle into the next maybe 1 to 2 years. Because it's a super cycle degree event, maybe it extends a little more in time versus what happened prior in the prior cycle. But time in terms of market is not the issue. I think economy would take its own sweet time. The stock market corrects faster and bottoms out well ahead of the economy, and so this cycle could complete anywhere in the 1 to 2 years time frame. So my sense is, if not by 2016, by 2017 we would have started what should be the Condorcet spring, which is essentially the beginning of the next super cycle degree bull market. So that's the optimism. That's the best thing that could happen, and if we are into the last phase and we can see exactly that what's coming next, I think the period to be pessimistic or skeptical is already behind us. I mean, like I said, if I started writing these articles in 2009 and up to 2013, I thought we are still there. In fact, the original timeline I'd given was that the winter would end by 2013 when I wrote that in 2010. So after 4 years, we'd still not bottomed out, because when I looked at the outside perspective, I mean, if you saw the long short report in August 2013, I said this is a sentiment extreme. The market could go back to 6100. Why not? And I felt that I should have just continued to ride that move on. But what it didn't match with, I mean, while it may have been a rally all year long, it didn't match with the economic cycle data points that should have been complete by that point to say that the winter phase itself is over. And that's a question I got for several months, or for the next 6 months till the Modi rally took off, as to would you now consider that the winter phase is over? Now, when you're getting a bull run and stocks are running up 10-20% a day, which is what you saw after the elections, it hardly makes sense to talk about that. But now, months later, as we've seen for the last 6 months, the indexes kept pushing higher, but the number of stocks which are participating have just kept declining. Most of the stocks that went up in June, July are already down 30 to 50%. A few of them continued to head higher and are now beginning to lose momentum. So you've got this complete distribution phase which has lasted far longer than I've seen in any previous cycle. But all said and done, I think this month's movements and the end of this month's move essentially is a sign that that pattern is over, the distribution phase is over, and we are into now the last bear cycle, and that's good. Now we have a vision into what lies ahead, and the Condorcet spring, the next bull market, essentially would be a 10 to 30 year event. So it's huge. It's going to be long and very long in time. Essentially, the message then from this update is that once you survive this period, you survive and then you prosper. I think it's as simple as that, and it's as silly as that. And I'll continue to update those data points, and we should be able to see where the market bottoms with those data points. But like I said, the economic data points will lag the stock market because the stock market will bottom out much before the economic data points do. But you will have seen a sufficient part of that cycle having turned and started to head the other way, which is what will give the comfort that yes, now the news is turned bad enough for a larger degree cycle to end. So that's all in this update. Thank you.